Welcome back to PHACTS, the Prentice Hall Accounting Tapes. Before we begin, see your instructor for the fact sheets for Unit 4. Last time we talked about the accrual basis of accounting. We said that it gives us a reliable measure of income because it satisfies the revenue principle and the matching principle. Then we talked about why accrual basis accounting requires we adjust the books at the end of the period. We made adjusting entries in the journal and then posted them to the ledger. Thus, we can measure the income properly and update the accounts in order to prepare the financial statements. Today we're going to put it all together and explain all of the steps in the accounting cycle. Just what is the accounting cycle? Well, it's the process by which accountants produce the financial statements for a specific period of time. During the period, the transactions are recorded and posted, and then a trial balance is prepared. At the end of the period, adjustments must be made for prepaid expenses, depreciation, accrued expenses, accrued revenue, and unearned revenues. An adjusted trial balance is prepared and then used to prepare your financial statements, the income statement, the statement of owner's equity, and the balance sheet. Closing entries are recorded and posted, and the post-closing trial balance is prepared. Now, accountants will often use a 10-column worksheet to complete their end-of-the-period work. There are 10 money columns, 5 sets of debit and credit columns, 1 for the trial balance, 1 for the adjustments, 1 set for the adjusted trial balance, 1 set for the income statement, and for the balance sheet. The worksheet is a summary device used to speed the preparation of your financial statements. It is not a formal accounting record. To complete the worksheet, you must first write the account names and balances in the trial balance columns. Be sure you total the columns and verify that debits equal credits. Next, enter the adjustments in the adjustment columns. Total these. Again, your debits should equal your credits. If not, make the necessary corrections. In the third step, calculate the adjusted balance for each account by taking the trial balance figure and adding or subtracting the amount of the adjustment. Enter this new balance for each account. Total your adjusted trial balance columns. Fourth, carry the adjusted balances for assets, liabilities, and owner's equity to the balance sheet columns, and the adjusted balances for revenues and expenses to the income statement columns. In your next step, calculate the amount of net income or net loss by taking the difference between the total revenues and the total expenses on your income statement. Add this amount to the smaller side on both the income statement and the balance sheet. Total your columns. We have completed the trial balance, adjustments, and adjusted trial balance columns for the Ibsen Advertising Agency. This partially completed worksheet is found on page 1 of your fact sheet. Let's finish the worksheet together. The accounts for the Ibsen Advertising Agency are in general ledger order: assets, liabilities, owner's equity, revenues, and expenses. Remember that assets, liabilities, and owner's equity are the balance sheet accounts, and revenues and expenses are the income statement accounts. The balances for the cash account through the Frederick Ibsen withdrawals account should be carried over to the balance sheet columns. The balances for the service revenue account, all expense accounts, and the interest revenue account should be carried over to the income statement columns. Turn off the tape and take a few minutes to do this. Then total the debit and credit columns on the income statement and the debit and credit columns on the balance sheet. Let's see how you did. The debits on the income statement add up to $71,000 and the credits total $134,000. Your debits on the balance sheet are $132,000 and the credits $69,000. The difference between the total credits and the total debits on the income statement is the net income or net loss. The Ibsen Advertising Agency has a net income of $63,000. This was found by taking $134,000 in revenues and subtracting $71,000 in expenses. This difference should be equal to the difference between the debits and credits on your balance sheet. $132,000 in debits minus $69,000 in credits also equals $63,000. Add this net income to the smaller side on both the income statement and the balance sheet. Take $63,000 and add it to the debit side of the income statement because the revenues are greater than the expenses. Add $63,000 to the credit side of the balance sheet because net income represents an increase in owner's equity. The total debits and credits on the income statement are $134,000, and the total debits and credits on the balance sheet are now $132,000. Keep in mind that if the debits on the income statement are bigger than the credits, there would be a net loss. This loss is added to the credit side of the income statement because your expenses are greater than your revenues. Also added to the debit side of the balance sheet because a loss decreases owner's equity. Now that the worksheet is completed, the financial statements can be prepared. The income statement, statement of owner's equity, and balance sheet can be found on page 2 of your fact sheets. Notice that the net income on the income statement is exactly the same as that on the worksheet, $63,000. The investments during the period and the net income are added to the beginning capital, and the withdrawals are subtracted to determine the final capital on your statement of owner's equity. 0 plus $30,000 plus $63,000 minus $26,000 equals $67,000. This final capital goes on the balance sheet. Your total assets, $102,000, equal liabilities, $35,000, plus the owner's equity, $67,000. The balance sheet prepared this time is called a classified balance sheet. Assets and liabilities are classified as current or long-term. Such classifications reflect liquidity, a measure of how quickly the item may be converted to cash. The operating cycle is the time span during which the cash is used to acquire goods and services that are sold to customers who in turn pay for their purchases. Current assets are expected to be converted to cash, sold, or consumed during the next year or within the company's normal operating cycle, if that's longer than a year. The current assets for the Ibsen Advertising Agency are cash, accounts receivable, notes receivable, interest receivable, and office supplies. These are listed according to their liquidity. All other assets are long-term assets and are used to operate the business. The most common category of long-term assets is plant assets or fixed assets. These are generally listed in the following order: property, plant, and equipment. All plant or fixed assets depreciate with the exception of land. Therefore, the book value of the company's building, equipment, automobile, or any other depreciable asset is calculated by subtracting its accumulated depreciation from the asset's cost. The Ibsen Advertising Agency has two plant assets, land and equipment. Equipment is the only depreciable asset. Therefore, it has a contra asset, accumulated depreciation equipment, related to it. Your liabilities are classified according to their due date. Current liabilities are due within a year or within the operating cycle if it's longer than a year. All of the Ibsen Advertising Agency's liabilities are current liabilities: accounts payable, salary payable, and unearned service revenue. Long-term liabilities are due in more than 1 year. Examples include long-term notes payable, mortgage notes payable, and bonds payable. The portion of long-term debt due within the year is shown as a current liability. At this point, the Ibsen Advertising Agency doesn't have any long-term liabilities. The capital is the ending capital that was calculated on the statement of owner's equity. We took beginning capital, added investments, added net income, and subtracted withdrawals. After preparing the financial statements, the adjusting entries must be recorded and posted. The information to make these entries is found on the worksheet in the adjustments column. Record the A debit and the A credit, then the B debit and the B credit, and so on. Remember, we labeled these adjustments just in case you might have two with the same dollar amount. Record these adjustments for the Ibsen Advertising Agency in the journal found on page 3 of your fact sheets. Let's do these together. On December 31st, we'll debit office supplies expense and credit office supplies for $3,000. We'll debit depreciation expense equipment and credit accumulated depreciation equipment $4,000. In our next adjustment, we'll debit salary expense and credit salary payable $1,000. On the 31st, debit interest receivable and credit interest revenue for $1,000. Notice that the last two both were for $1,000, and having the letters to identify them helped us record the right debit with the right credit. In our last adjusting entry, debit unearned service revenue and credit service revenue for $2,000. When these adjusting entries have been posted to the general ledger, the accounts will reflect the same balances as on our financial statements. The next step in the accounting cycle is the process of closing the accounts. The nominal or temporary accounts must be closed out. The revenue, expense, and withdrawals accounts are your nominal accounts. They're only used to record transactions for the current period. That's why we call them temporary accounts. Your assets, liabilities, and capital accounts are your balance sheet accounts. These are called permanent accounts. Their balances are carried over from one accounting period to the next. Income summary is a special temporary account used in the closing process. It's a summary of the income statement accounts, revenues on the credit side and expenses on the debit side. The closing entries are merely a transfer from one account to another. All withdrawals, revenues, and expenses must be transferred to the capital account. Income summary is used to hold the revenues and expenses until the net income is transferred to capital. We'll have 4 closing entries that we will be doing. The first one is to transfer each credit balance account on the income statement to income summary as a total credit. To do this, debit each credit balance account individually and credit income summary for the total. Take a look at your completed worksheet on page 1 of the fact sheets. There are 2 credit balances on the income statement. For the Ibsen Advertising Agency, the first closing entry would be debit service revenue $133,000, debit interest revenue $1,000, and credit income summary $134,000. Record this in your journal found on page 4 of your fact sheets. There are 5 balances on the debit side of the income statement. Your second closing entry is to transfer all debits on the income statement to income summary as a total debit. Debit income summary for the total and credit each debit balance account individually. For the Ibsen Advertising Agency, this entry on December 31st is debit income summary $71,000. Credit salary expense $41,000. Credit rent expense $18,000. Credit utilities expense $5,000. Credit office supplies expense $3,000. And credit depreciation expense equipment $4,000. At this point, the income summary account has a credit entry of $134,000, representing the total credits on the income statement. It has a debit entry of $71,000, representing the total debits on the income statement. The $63,000 credit balance in income summary is the net income for the period. This net income must be transferred to the owner's capital account. In doing so, income summary, a temporary account, will be closed out and the capital account will be increased by the amount of the net income. This third closing entry is a debit to income summary and a credit to the capital account. Look at the bottom of the worksheet. This is shown when the net income is added on the debit side of the income statement and on the credit side of the balance sheet. Your third closing entry for the Ibsen Advertising Agency on December 31st is a debit to income summary for $63,000 and a credit to Frederick Ibsen Capital for the same amount. If there had been a net loss, income summary would have a debit balance after closing out your income statement accounts. This loss would decrease owner's equity. Therefore, you'd have to debit the owner's capital account and credit income summary for the amount of the net loss. The withdrawals must be transferred to the owner's capital account in your last closing entry. The withdrawals account has a debit balance and must be closed out with a credit. Since withdrawals decrease the owner's equity, the capital account must be debited. To close out the withdrawals account for the Ibsen Advertising Agency, on the 31st of December, we would debit Frederick Ibsen Capital and credit Frederick Ibsen withdrawals, both for $26,000. After recording and posting these closing entries, all of your nominal or temporary accounts have a zero balance. The withdrawals account, income summary, revenue, and expense accounts are all closed out. Your capital account now shows all of the changes in the owner's equity, just like the statement of owner's equity. Ibsen started his company at the beginning of the period, so there wasn't any beginning capital. Look at the T account. We added net income and investments on the credit side, and we subtracted withdrawals on the debit side. This gave us a final balance, $67,000 for Frederick Ibsen Capital, just like we had on the statement of owner's equity. The accounting cycle ends with the post-closing trial balance. As its name indicates, it's a trial balance taken after the closing entries have been recorded and posted. It's a trial balance of all your permanent accounts, assets, liabilities, and owner's equity. It shows that the debits equal the credits for these permanent accounts on the last day of your accounting period. Notice that the same accounts appear on the balance sheet and the post-closing trial balance, your assets, liabilities, and owner's equity. But the presentation is a little different. The balance sheet shows that assets equal liabilities plus owner's equity. Your post-closing trial balance shows the debits are equal to the credits for the same accounts, assets, liabilities, and owner's equity. We have now covered all of the steps in the accounting cycle for a service enterprise. They include recording and posting transactions, preparation of the trial balance, completion of the worksheet, preparation of the financial statements, the income statement, statement of owner's equity, and balance sheet, recording and posting the adjusting entries, recording and posting the closing entries. The last step is the preparation of the post-closing trial balance. In our next session, we will go through the accounting cycle for a merchandising concern, one that buys merchandise to resell. In the meantime, you might want to try a problem or two from your text or your study guide. Review the tape if necessary.